The Rebel Capitalist Show.
For the average person out there, let's talk about your views on just broad S&P, broad bonds. Let's keep it simple, and then let's go over gold and Bitcoin.
Sure. When I look at the S&P 500, I'm not super enthused about that index. I like the equal weight version of the S&P 500 a little bit more than the market weight version. There are simple ETFs that you can do to get exposure to that.
Explain why, Lynn, because I don't know that most people understand the logic there.
Yeah, so if you look at the normal market weight S&P 500, the top 5 or 10 companies account for a pretty significant percentage of that 500 company index, because Apple, for example, is weighted 20 times more heavily than American Express, or whatever the number is, because it's based on market capitalization. And so if you were bullish about those top companies, well, then you probably would want the market weight version. Whereas if you were, you think that there might be more action in, say, the middle of it, and you want kind of that more diversification, well, then the equal weight version gives you access to the same companies, but without that concentration in the big, FANG stocks that are, at this point, I think pretty pricey. I'm also finding that it really kind of depends on the specific company. And so I like that mix of, I use a few ETFs for broad exposure, but then I personally like to go out and buy individual equities. And so I can say, I don't want Apple, but I want Amazon, for example. I don't want, this company, but I want that company. And so I try not to have too much of a prediction about what the S&P 500 is going to do, because it's partially going to depend on what happens to the denominator currency. But overall, it is in many ways quite stretched. We're at 200% market cap to GDP, and now we're starting to talk about things like increased corporate taxes, and things like that. That if they were to get enacted, are somewhat of a headwind towards the S&P 500. And so I have to kind of keep track of those macro variables and change my outlook over time. But I'm not super enthused about the S&P 500 at this price level. But at the same time, if you look at the treasury market, you're not getting a ton of yield for what I'm expecting from broad money supply growth, from consumer price inflation. You're getting effectively a negative real yield, and so that's not a place I really want to be in either. I guess if I had to pick, I'd almost rather be in the S&P 500, for the next 20 years, because at least I'm pretty sure it's not going to go to zero. Whereas if you're holding currency, it's always possible that you could literally lose your entire investment. Right. And so between the two, I like equities more than bonds, but I'm not super thrilled about either. When I look at areas that I'm more interested in, it's certain foreign companies, or certain specific companies in the U.S. As an example. And so I've been pretty bullish on some things on the more value side of the spectrum, like some of these commodity producers, some of these banks. Now the banks are actually getting a little bit stretched here, but things that are on more the value side of things that are kind of out of favor are things that I've been more bullish on. And then when you look at the precious metal space, gold has had a pretty big correction here, and I pretty much like it from these levels. It's partially going to depend on what happens with real interest rates, and so if bond yields go up faster than inflation, at least as officially reported, because that's what the the paper gold market looks at. If that continues to happen, you could get another low in gold. But overall, I think we've de-risked it a pretty significant amount here, where I like to have that as part of my portfolio. And then with Bitcoin, you have much more volatility there. But I still am, say, constructive for the next 6 months or so, based on where we are in the halving cycle, based on what I'm looking at in terms of on-chain indicators, in terms of supply inflow or outflow from exchanges, and some of the dynamics that are happening there. And so rather than have a concentrated bet on any one thing, I like a mix of things. So I have individual stocks, I have certain ETFs, I like certain regions more than others, and then I incorporate, gold, silver, Bitcoin, commodity producers, things like that. They have that rather diversified mix, but it's generally tilted more towards that reflationary outcome rather than a pure all-weather portfolio.
Yeah. So one of the things that we talk about all the time in Rebel Capitalist Pro with the members there on the live streams is some of the picks that you have in your own personal portfolio that are overseas. And I think a lot of these companies people most likely will have never heard of unless they're actually a member of the forum. So let's go over just 3 of your favorite foreign stocks right now.
So as an example, I've been pretty bullish on the Japanese trading companies. And so those are large, kind of partial commodity producers, but also industrial suppliers, and they own some real estate like convenience stores or supermarkets. And so, for example, I've been bullish on Mitsui as one of the examples of a Japanese trading house that has pretty diversified commodity exposure, but that also has that ballast of those more cash flow steady businesses. And you're getting a pretty high dividend yield. You're getting a pretty cheap valuation. And so that's something I'm happy to kind of buy and hold for a 5-year period and see how that plays out. I think that would benefit from the more reflationary trends if some of that thesis plays out. And you're not really, your downside is not super high compared to the upside you could get out of it. Yeah, you're getting paid a pretty substantial dividend yield above the Japanese average, above the U.S. average, to hold it. And so you're not getting explosive growth, but you're getting a diverse mix of businesses that generally benefit from currency devaluation, and it has a global exposure. So it's not just tied to Japan; it's tied to what commodity prices do, what emerging markets do, things like that.
And the businesses actually make profit.
Exactly. Yeah.
As crazy as that sounds.
Exactly. Yeah. And then I've been bullish on Sberbank of Russia as an example. It's a bank. They have a positive yield curve. It's historically well run, despite the fact that the Russian government owns a big stake in it. You'd think it'd be poorly run, but it's actually historically been a very well run bank with a very high return on equity, high dividends to shareholders. It's trading at a single digit price to earnings ratio, even though it's been it's held up very well in this environment. And then what's interesting about it is that they actually have a lot of technology bets, because their mobile app is one of the most heavily used in the world. Basically, they have a higher mobile penetration than most other banks around the world. They've adopted technology very well. Basically, their app is almost as popular as some of the social media apps in that country. It's very heavily used, and they've expanded into like cloud computing. They make a lot of little investments, and then sometimes they own a stake in investments. Other times they own the whole thing, and so it's actually you're getting like a bank that's it's paying a high dividend yield. It's growing at a a moderate rate. It's very cheap, but then you're getting like almost like a call option on technology over the next 5 to 10 years. And so there is regulatory risk. Like we could come out and say Russia and U.S. Tensions increase, and then Americans can't own Russian stocks anymore. There's always tail risks like that. So I would manage the position size. But that's an example of something where people say everything's expensive. It's like, well, here's a company with a single digit price to earnings ratio and actually a pretty stable business. And so that's another kind of area that I like at the current time.
Yeah. What about if someone's like a U.S. citizen right now, all their expenses are denominated in dollars? What if they're like, okay, Lynn, those sound great, but what's my currency risk?
So at that point, you have basically with all these kind of foreign investments, you do have currency risk. And now with Mitsui and Co., because you're largely tied to commodities, it's maybe a little bit less currency risk than you'd expect. It's basically got some global exposure, so it's not just purely a yen-based trade. Sberbank, being a bank, is very tied to Russia's currency. And so Russia's currency is one where a lot of people are concerned about it because it's volatile, it's tied to energy prices. But if you look at the actual fundamentals of it, Russia has very, very high foreign exchange reserves relative to its broad money supply. They also, they went into the COVID, the cerveza sickness crisis with, a fiscal surplus and a trade surplus. And of course, that was disrupted by, their own stimulus efforts and the fact that oil got very cheap. And so, like anyone else, they're going through a period of pain right now. But structurally, they're in decent shape. And so there are issues there. Like you have demographics issues. You generally have a very high wealth concentration there because you have pretty high corruption in Russia. You have all sorts of, the list of issues there is endless. But if you look at kind of the fundamentals of the currency, it's actually pretty solid. They have, a large amount of foreign exchange reserves, including gold, relative to their broad money supply, and they have, positive real interest rates. And so overall, even though it's a volatile currency, it's a currency that I don't mind having exposure to. But another thing that people ask me is I often say that I do think that that many of these foreign indices could do better than the U.S. indices over the next 5 or 10 years. And so they say, why do you have any U.S. stocks at all? Why not just have pure foreign exposure? And that actually partially goes back to your question that my expenses are denominated in dollars, and so I generally don't want a portfolio that's say 100% foreign equities. I want to have that mix. So I say, okay, in the U.S. market, what stocks or sectors do I think are attractive? And I'm happy to buy those. And then, I'm happy to then have a big slice of my portfolio that allocates to all these other bets that are out there. And so that's how I approach it, to kind of balance currency risk with, basically diversifying my currency exposure, so I'm not fully tied to the dollar either. So if the dollar weakens, my foreign companies likely do pretty well in dollar terms. And if you were to get those other ones weaken, well, then I'm still heavily diversified. My U.S. Equities are probably doing pretty well in that environment, and things like that.
All right. So one more. What do you think? I mean, I know we've talked about Singapore banks, Luke Oil. I'm sure, is that still one of your favorites, or has that gotten a little more expensive?
It's got a little bit expensive, but I'm still long that one with a pretty long-term outlook. I guess instead of giving another Russian pick, I would say, um, one of the stocks is really out of favor right now is Alibaba of China,
Hmm.
because they've had some regulatory issues. Basically people are remembering that that is a communist country, and there's all sorts of issues there, and it's actually near the cheap end of its historical price range, and so I don't. It's not a company that I want to put a lot of money into, because it's kind of like the Russian issue. Like you could have regulatory issues that prevent you from owning it. Same thing with China. Whenever you're investing in China, you have accounting risk, and you also have basically the risk that one day Americans just can't own some of those companies, which we actually started to see play out a little bit last year, where there basically was increasing scrutiny on allowing Americans to own Chinese equities. But at the current time, Alibaba is so out of favor, and its fundamentals are still very good. I mean, it's a cloud computing company. It's not very expensive based on its growth rate, and so as a small slice in portfolio, I actually think there's a lot of opportunity there. And so that's, there are cases where I think there are some really good growth stocks out there. They're just not necessarily the apples of the world. They're ones that, if for one reason or another, are not as heavily favored as some of the popular ones are.